Greetings, everyone. I'm David Darst. We hope you've been having a good long weekend that went through Memorial Day in the United States. And it was a very good week for the stock market last week in the United States. The Standard & Poor's was up 6.6% to close at 4158. So it's now down 12.8% on the year. It was a very strong sequence of days. Monday, the stock market was up 1.9%. Tuesday, it sold off 0.8%. Wednesday, up 1%. Thursday, up 2%. And Friday, before the long weekend, up 2.4%. So a very strong week. Basically, it was driven by several things. One, you had encouraging results from Dollar General, from Dollar Tree, from Macy's. So these are much more in the mainstream area serving the consumer. Walmart, of course, and Target the previous week had gotten investors a bit upset and nervous that inflation was hurting the consumer's willingness to spend. Ross Stores, Ulta Beauty, these were up over 20% last week after good comments and reporting good results. You had Citicorp, Jane Fraser, the CEO of Citigroup. You had Jamie Dimon of J.P. Morgan. Both of those made good comments about the economy early in the week. You had some economic news. The second quarter GDP results were revised downward from minus 1.4% annualized to minus 1.5%. However, the consumer part of that, which is the big driver of the economy, as you know, the consumer part of that was raised up from below 3% to above 3%. You also had the Federal Reserve, the minutes were released from the May 3rd, May 4th meeting of the Federal Open Market Committee meeting, and those notes, those minutes, showed that there was the market saw this as somewhat less dogmatically hawkish than they had been fearing. You had also the core, this was, I think, one of the big drivers on Friday of last week, the core personal consumption expenditures. This is the Fed's preferred measure after taking out food and taking out energy. The core personal consumption expenditures index for April was up 4.9%. That is actually down from 5.2% in the month of March. So people see, okay, well, maybe inflation is beginning to soften a little bit, particularly in the goods side, even though in services you still have some degree of price inflation. The two-year Treasury last week was down 12 basis points to 2.48%. The 10-year Treasury was down 4 basis points to 2.74%. And the 30-year Treasury was down 3 basis points to 2.96%. So you had the interest rates down somewhat. Oil was up 4.3%. It's up 58%. The West Texas Intermediate oil price at $115.47, and natural gas, which is, you can imagine, has been very, very strong. It closed on Friday at $8.73 per million British thermal units, per million BTUs. It was up 6.7% for the week. It's up 133% for the year to date. NASDAQ was up 6.8%. Everything was up over 6% last week. The S&P 500, NASDAQ, and the Dow Jones Industrial. All three of those were up over 6%. NASDAQ was up 6.8%, but I would remind everyone that it is still down 28% year to date. Big gainers, the top market cap companies. You had Apple. Apple was up 8.8% last week. Microsoft, the second largest market capitalization, was up 8.2% last week. Amazon was up 7%. So of the top five, 3 of them were up in the high 7s, low 8%. Facebook and Alphabet did not rise nearly as much. Facebook was up only 0.8%, 0.8%. And Google, Alphabet, it's known as now, was up only 3.1%. Why? Because both of those, you recall, are dependent on advertising. Both of those business models for Facebook, Meta platforms, that's what it's known as, Google, Alphabet, both of those are highly dependent. 80% or more of their business is advertising revenues. And if we're going to have an economic slowdown, which we do expect in the second part of this year, if we're going to have an economic slowdown, I think it will be a slowdown. I'm not yet on board to start calling for a recession. The market was no question oversold. This was a sentiment-driven rally last week. You had all these things that made the investors say, you know what, the glass is not half empty. Maybe it's partly half full, and they came pouring back into the market. We view this big rally with some degree of reservation. You need to see the Chinese lockdowns begin to open up somewhat. I would say that's about 50 to 60% of the way there for me to call for that obstacle to the market to be removed. The second is the Fed. And there you need inflation to be peaking and the Fed easing its hawkish rhetoric. We will see how that develops. We have the minutes that we looked at last week, and the market seemed to interpret that pretty well as the personal consumption expenditures. So I'd say that's about 40 to 50% of the way there. And the last one is the geopolitical tensions, particularly in Russia, the Ukraine, and all of that. There I don't see as much progress, maybe 20% of the way there. These are rallies to be sold, we think. Stay defensive and continue to upgrade the quality, go up in quality in the portfolio. This week, you get the jobs numbers on Friday, expected to be about 350,000 jobs, 3.5% unemployment, and you will get the purchasing managers indices for both manufacturing and for services this week. So we'll be watching them closely, and we look forward to visiting with you very, very shortly. Have a great week.